Live. Good afternoon and good morning, depending on where you're dialing in from. Welcome to this panel on how COVID has altered consumption and consumer trends in Southeast Asia. With me today is Nick Cator from Venturi and Jeff Joe from Alpha JWC. Welcome, gentlemen. How are you guys today?
We're great,
Great.
thanks. Great to see you guys.
So let's kick this off, right? As I told Joji, for this panel, I'm going to keep it as a free-flowing conversation, given that all three of us have been investing in consumer businesses regionally and globally over the last decade. And as we sort of refined and change our playbook, as our relative markets evolve and GDP consumption grows, the impact of COVID was unforeseen. And I want to spend most of the time today talking about how we used to invest pre-COVID, and let's take February or March 2020 as COVID D-Day, and how that's changed for us as a firm, and how we look at trends and how we look at investment themes, given the impact of COVID over the last 19 months, and how COVID will continue to impact us in the coming years. So let me just kick this off with Joe. Joe, you've been sort of very much focused on regional investing with a heavy bias towards Indonesia. Been doing it for a very long time. Alpha JWC is clearly one of the early movers in Indonesia. Can you tell us what and how you used to invest and select consumer businesses prior to COVID, and how that's changed over the last 18 months?
Yes, thanks, Deepak. So I think the biggest difference on how we invest, especially during COVID, is that pre-COVID era, when we invest, it's all about growth. It's about the fact that we are using the venture capital model in the consumer business. It gives us a different playbook compared to the conventional model, right? So it means that we can experiment more. We can do things more aggressively. For example, like hiring ahead of the curve, and also maybe be a bit more aggressive in terms of expansion, right? And then not thinking about the short-term profitability. One thing that's very different in the current COVID era is that, number one, is no longer about growth anymore. In fact, we might not have a clear visibility on when this whole COVID is ending. Just to give a bit of stats, some of our companies, the one that's some of the top performing ones, already achieved pre-COVID level, above pre-COVID level in the past few months. But still, that's not 100% certain, right? In certain months, yes, they are growing above the pre-COVID level, but depending on the COVID situation, sometimes there's a restriction and all that, right? So
Jeff, on that point, maybe you can spend some time as you narrate the story or your experiences. In every portfolio, COVID would have impacted certain categories of businesses very differently. And as you talk about businesses in your portfolio, which are ahead of the curve or ahead of budget, or where there have been headwinds and they're lagging budget, talk about how the differences have played out and what led to those changes. What in COVID helped some businesses and what in COVID did not help some businesses?
So number one, I think we categorize it between the necessities, the necessity goods. For example, like coffee, we invest in Kopi Kenangan, right? The coffee is still necessity. Second is Lemonilo. They have a lot of healthy snacks, but instant noodle is staple food, right? So those kind of products are pretty much very resilient. So we can still see some growth in that kind of company. But in the one that's maybe in a bit of lifestyle, right? We have a fashion subscription model and style theory. Of course, they impacted negatively on this COVID. And just to finish the thought on how do we think on the consumer play during this COVID this COVID era, is that now we think that the venture capital model is very beneficial, because in a venture capital model, we are used to burn rate, but the conventional consumer companies maybe not really, used to having a prolonged period of burn rate or burning money, right? So that's something that I think is good about our playbook. Means that we can be more defensible, but we are really watching closely on when the COVID can recover and what's the playbook to spur growth after the COVID recovers.
Thank you. Good kickoff, Jeff. Nick, as you think about consumption trends pre-COVID, during COVID, and clearly many of these trends are going to sort of be much longer term as consumers over the last 18 months have changed behavior, and some of those changes will remain intact. And using your lens as a consumer investor over the last decade, having invested in the US, invested in Europe, investing in China, India, and Southeast Asia. How do you see this sort of playing out, at least from a Venturi lens, as you start your new firm, have had your first close? How has this altered how you will go to market and think about investing?
Thanks, Deepak. Listen, I think first and foremost, the good news is that long-term consumption growth trends are positive, right? And so if you look at it, there was a bit of a blip. Of course, consumption per capita decreased a lot, as Jeffrey said, in 2021, in 2020 and 2021. But if you think of 2025, consumption per capita should be at still around 1.5 times more than 2020. So, over 5 years, there's still going to be a lot of consumption coming in the market. What we've done is, when we looked at COVID, I think the first impact that we saw was that there was initially a boost towards digitalization. So all the businesses that were kind of online versus offline kind of improved. So, we're still looking at companies that have high growth, penetration in a category or new niche, or disrupting one, and then all, of course, that have sound unit economics, right? So I think that's one focus that happened for a lot of founders. The first phase of COVID, the first 3 to 6 months, a lot of business all of a sudden found that they could actually improve their gross margins by 5 to 10%, whereas most founders before said that would not have been possible. All of a sudden, all businesses, just found like huge operation improvement. So I think that's good for the industry. I think that makes businesses more resilient, more sustainable. So that's the first thing that we saw. Then we saw, I guess, much bigger impact in offline businesses because the physical distribution was more impacted. One of our companies, LiftSpace, that is now doing great again, but of course had to do physical installations during COVID. And as you can imagine, if either the consumer or the installer is suffering from COVID, unfortunately, that cannot happen, right? So I think offline businesses or businesses that had actually either through distribution, retail, or more where there was a physical service involved, suffered more. However, now, and so online businesses benefited. However, now I think we're coming around, especially in India, we're kind of seeing back a return to normality. And I think, in Indonesia, Thailand, Vietnam, Singapore, hopefully over the next 6 months, we'll see that happen again, of course, because India has now vaccinated more than 50% of their population, doing that they're doing their own vaccines, whereas Southeast Asia, unfortunately, is lagging behind a bit. But what we do see is a fundamental kind of tilt or change, if you want, in consumer mindset. And for us, of course, that has kind of highlighted, I wouldn't say new themes, but that has fast forwarded a number of themes that were kind of, core to our investment thesis. One, of course, is around rapid, digital adoption and e-commerce growth. So if you look at Southeast Asia, the average GMV per consumer spent online grew 60% between 2021 and 2020. So that's just there. That's a huge boost.
Yeah, absolutely.
What we've seen as well is that the numbers of categories in which people are shopping is much, much wider, right? And so now people are, on average, transacting across 8 categories, which is, gone up from 5. So before people would just do fashion, food, whatever, and now they've increased from 5 to 8 categories, right? So just also the breadth and the depth where technology and online is disrupting the landscape in Southeast Asia and in India is just, growing and accelerating. So that's definitely one that, we're following closely. And so as much from our perspective as probably I would have always said before, when I was meeting investors, I would have said, hey, we're going to do offline and online, we're a consumer fund. Probably today, the reality is that we are seeing and focusing more on tech-enabled businesses. So that's kind of the first impact, I think, that, we're seeing in our investment strategy. We're still looking at offline, of course, but there's still today, there is definitely in Southeast Asia, less growth than what you're seeing in kind of online models. Another trend that we're seeing and that we quite like, and I know that you like it as well, I believe, Deepak, or tell me if I'm wrong, is kind of convergence of kind of online and offline experience, right? And so you've got that convergence of physical and digital retailing, and so omni-channel is becoming much more prevalent and important for the consumer. We do believe that people who have been shopping online will want to go back offline as soon as they can go out again. And so there's a lot of new and interesting business models that really kind of blend both of those kind of experiences together, and that can actually give a higher engagement to the consumer and better experience to the consumer. So that's also something that we're focusing on. Of course, health, health and well-being is really important for consumers as well. There was a survey, I believe, by EY for the future of retail in India, done recently, that said that 70% of consumers reported that they would switch to alternative brands that would offer better hygiene, safety, or trust. And I think that's also a fundamental shift that has enabled brands to disrupt faster than before, is that people are now much more conscious about immunity levels, health, well-being, and they're actually spending more, but they're also much kind of more critical of existing brands. So, 50% of consumers will now closely read the labels or the nutrition labels on food and beverage, right? So this is a completely new trend. 60% of consumers will do extensive research on products and services that they consume through reviews, through kind of, Google. And so I think that's also opened the way for kind of the brands that, we would typically invest in to actually disrupt faster. And so I think that's why we're kind of seeing really these long-term trends that are continuing to accelerate.
I think that's very interesting. And I think you brought up 2 or 3 very relevant points, which are sort of reopening the debate that consumers are having, because there was a clear trend. And a large part of what we do at DSG is our belief that many of the brands in the markets we invest in 10 years from today are being created today. These are the brands taking away significant market share from the incumbents, the giants. Think of Unilever, P&G, Nestle, etc. And that trend was intact for a long time pre-COVID. What happened during COVID was interesting. Consumers wanted to buy local, wanted to buy new, wanted it to be more sort of challenger or insurgent. But during COVID, in the early point of COVID, many of the startup brands that I would normally back were not as large or sort of ready to take on the challenges of COVID. Significant supply chain issues. They were out of stock for much longer than the big brands. And the whole question about, do you trust a new brand, or do you go back and buy a Unilever or Nestle who have years of science, right? So many of the themes that were driving the growth of the brands that I back, you back, Jeff backs, were being questioned. 18 months into COVID, many of the brands that started pre-COVID are doing well, but many are struggling. So there's a whole debate today as we sit down, and I had the opportunity of speaking to 3 board members at 5 of the biggest CPG companies over the last 3 or 4 weeks, and they would openly tell you we've always been losing market share in most of the markets slowly. In 2019, the pace of market share loss accelerated, but in 2020, everyone saw market share being reclaimed. The question was it because the competition was out of supply, or because consumers now started trusting big brands again? So as we think about investing going forward, the debate my team and I are having is, how do we think about the given assumption that people were very supportive of local brands who are taking on the big giants, David versus Goliath, or do we now have to reassess the fact that people might now gravitate towards the safer brands? It's interesting. So let me share 4 things that we've seen at DSG, and then I'll ask you to see how you guys sort of perceive this. Clearly, step change in online. All of us agree that online and being digital has been accelerated, and the point of inflection is steeper, no going back. The focus on health and wellness, Jeff spoke about it. Nick, you mentioned it. Again, people are spending much more on health and wellness. The third thing we've seen is, what is value? All of us are investing in Asia. Asia comprises of sort of developed markets like Singapore and Hong Kong, and many emerging markets like India, Indonesia, Vietnam, parts of the Philippines. And during COVID, everyone was either sort of saving more, they were earning less, and what they were spending on materially changed. The basket might not have changed, but they clearly were spending more on things that were better for you, health and wellness, and they were sort of moving from very premium to sort of mass market brands. So how has that sort of impacted your way of looking at the market, and has that impacted any of your companies? Let me start with Jeff, given your presence in Indonesia.
Yes, that's very, very good and interesting point, Deepak. So what we are seeing is that number one, I think, at least this is from Indonesian standpoint, there's a stronger movement towards local brand. So the national pride or the country pride, that's really important, right? So we can see that if, let's say, a brand that's playing that angle will have a meaningful traction. But I will say the biggest difference in the past 1.5 years, I would say that it's not so much the bigger established brands versus the newer ones, but I think how they engage those consumers, because now suddenly people are not going out. Suddenly the media of they can reach out the consumer are different, right? And in this topic, I would say that the newcomers, the startups, the one that's actually more comfortable in getting the attention of the consumer, engaging the consumer in a more digital way, will have an upper hand. But of course, the incumbent will have maybe a more budget to spend. But I would say at least what we are seeing in Indonesia is that the startups are more agile and they are managed to still keep growing. And I will say that they will continue gaining market share from the incumbents.
And Nick, what's your view on this?
No, I think, listen, we see the same underlying four trends that you mentioned, right? And it's impacting clearly all of the brands that we've invested in or that we're looking to invest in. And so that's definitely something that we're looking at extremely closely. I think health and wellness, clearly, we're seeing a reallocation of the consumer's markets to some more staples, but then in some specific verticals, such as health and wellness or whatnot, they're willing to pay a premium. There was a recent survey that said that 70% of consumers were likely to pay a premium for better quality, healthier foods versus pre-pandemic. So I think that's definitely been a big shift. That's we've seen. I know that you've kind of playing on that theme as well in a number of investments that you're doing, but that's clearly a focus for us. Value is still important because, for a year and a half, people have had less of disposable income in general. And so they have reallocated their disposable income within a number of different baskets. However, what we see as well, and one trend, I guess, which is linked to health and wellness and safety, trust, assurance, all of these themes that we've spoken of, is also, an interest or, in sustainability and purpose-led brands, right? I think that's something that we've seen. I know that trend has been in the West for some time, as you know, Deepak, we were in Oatly and a number of other kind of really purpose-led brands, but we do believe, and there's actually some quite strong data coming out of Southeast Asia as well, that consumers are 4 times more likely to purchase on a purpose-led brand, on a normal brand. And why? Because they will have a stronger belief in what the brand is telling them, right? And so we're seeing that as well come into, Southeast Asia, India, and I think that's a trend that we'll continue to see becoming stronger and stronger, because ultimately it's about trust. And I think that Jeffrey now as well is brands have been able to benefit in a way from COVID, and especially smaller brands, because all of the discussion has moved online. And generally, younger, more kind of disruptive brands are strong online because that's the best way for them, or an easy way for them to differentiate themselves, to get a share of voice. If you're on the retail and you're the big guy, it's easier for you to get, most of the shelves, right? However, online, you can differentiate yourself. And so that's why I think insurgent brands have had, a great share of voice. People have been more open and they've been able to establish trust. And so also kind of position themselves as an alternative. So I do believe, Deepak, coming back to your point earlier, that I mean, that's my personal view, but I agree with you that in 2020, as much as there was initially, before pre-COVID, larger brands, more incumbents were losing market share, I think that the improvement that they saw in 2020 was more linked to supply chain issues, and that, being available was the first thing that the consumer wanted, right? And I do believe that these large brands probably initially for the first few months reacted better, because I do think that based on the long-term trends that we're seeing in the market, insurgent brands or emerging brands will have, are much more aligned with the trends that we're seeing today. And then the incumbents will actually find it harder and harder, because I do think that what we've seen is that COVID has accelerated the long-term consumer trends that we've seen. I mean, the trends that we're speaking about today have been around for the last 5 years, right, Deepak? I don't know if you agree to that. Is it an acceleration, or is it a really new trends that you're seeing emerging?
I'll come back to how given that all of us by nature of our business, are backing the next champion, the next insurgent. So I'll come back to how the big companies are responding or will respond. But as we think about, how things are playing out, I want to remind all the participants that you can ask questions on the Q&A part of the website. Please do ask your questions. We will spend the last 10 minutes answering any questions, or if I feel that the questions could be sort of intertwined with the conversations we're having now, I'll actually bring the questions up while the conversation is ongoing. One thing I want to bring up that's impacting us as investors, and I know we spoke about this backstage prior to coming live, is the let me use the right phrase, explosion of Thrasio-like platforms. I won't say Thrasio-like clones. These are startups being funded on day one to acquire and roll up consumer brands. Some of them are sector agnostic, happy to buy anything in consumer. Some are much more vertically focused. And what we're seeing in India is a sort of a variations of this, where 4 or 5 existing large consumer brands, so these are companies who have revenues of 20, 30, $40 million ARR, are either raising their own Thrasio funds or are building up balance sheets at Holdco to acquire brands. And I would love to get your perspective as investors in consumer brands. What do you think of the Thrasio-like platforms? Are they a good news or are they bad news? It's clearly liquidity, new pools of liquidity who are sort of on one end of the spectrum, could be acquirers of brands via funding, which is good news for us. They could be competing against us for fast-growing brands that are looking for capital. What's your view on this? Is it good for the industry, bad for the industry? Let me start with Jeff.
Yes, Deepak. So I believe that it's a good for industry, because this is the problem that these Thrasio-like companies are solving. I realized, looking at some of the brand owners, not everyone wants to create a big multinationals. Some are just, some of them are just maybe a couple, right? Husband and wife working in a garage, is out of passion, and have built a good enough brand that if they can monetize now, they can get a few $1 million in their bank account, and they might be retired or do another set of passion, right? So I think the big theme here is that what to do with the owners and also the brands that do not really want to scale this business further, right? Will they just keep continue doing like that, or they sell it? So that's the question, right? And then what these kind of companies are doing is basically institutionalize that, right? By having maybe a more institutionalized platform for marketing, for content, for finance, for operations, for import-exports, right? So I believe that there's a big gap and a big opportunities in the market to do so. Will they compete with some of the brands that wants to grow bigger? I don't think so, because the playbook is different. For owners who are willing to get a VC funding to keep them, institutionalize them, and then keep growing bigger, then yeah, that's a different playbook. But there's enough opportunities for Thrasio-like model in Southeast Asia.
Yeah.
Nick, over to you. What's your perspective?
No, I fully agree with Jeff. I think it's a good thing for the industry. I think it's a different playbook, because the founders that we back, Deepak, have big ambitions, right? And we see it every day. They get offers along the way from strategics. They don't want to sell. They always dream about that. They want to be the biggest brand, the biggest recognized. So I don't see them selling. And I think they organize themselves in a different way by building a team, building an organization, building distribution, whatever, right? Generally, the Thrasio, and I know that now they're looking at some more established brands, but generally the Thrasio model is buying more small $3 to $5 million brands that have grown nicely, that are profitable, because it's a 1 or a 2 or 3 man. I mean, there's not much, right? It's just a product more than a brand, I'd say. And so the question for me, and we're looking actually at this, and we've met great founders that are kind of over the last year and a half. I mean, in Southeast Asia and in India, a lot of models or a lot of brands have emerged or companies have emerged that are doing this. I think what we're still kind of focusing on, and we're not a VC, right? So we come in at growth. So we come in when, I guess, the business model is proven, and we can see it. And so that's where, from a growth investor's perspective, I still have a few fundamental questions that, I'm still asking myself. One is, what is the real value add of these platforms? So, can I see operational leverage when you're bringing a brand into that platform? All of a sudden, brands can kind of, the products or the brands will grow. So that's one. What's the real value add operationally from a supply side, from a distribution side, from a sales side? Then the second one for me, and I still don't really have a clear view on that, is it more products than brands? A lot of the things that these brand aggregators are buying today are more products than brands, right? They're kind of single brands, single product brands, if you want. And so the question for me there is, are they going to end up with 500 brands, and how are they going to manage that? And so is each product going to be one brand, and then they're going to end up, having a huge portfolio to manage? So that's one. Can they actually create new products within an existing brand? The second one for me is also, what is the life cycle of these products? When you invest in a brand, you're creating an intangible value for the long term, right? So as you know, Deepak, that's what we invest in, right? We're creating a brand, and of course you can launch and evolve products over time. Now, when you're buying most of these things which they're buying, they're just mono product or just a couple of products. So how are you actually, is there actually brand value there? And so how do you, are you able to launch multiple products under the same brand? So that's the second one. And then the third one, I think, which will be interesting for me to try and understand, and we're spending time looking at that, is I think the difference that you're going to see between models in the US or in Europe and models in Asia is that, from the discussions that we're having with a lot of founders that are focusing on this, is they also look as strongly on the offline side. So I think they're really building an online, of course, that's the traditional one. You just buy the brands and push them on Amazon and Shopee and Lazada and all of that. But at the same time, you want to build offline distribution, because that could be a real value add. Now, again, how do you do that if you have hundreds of brands, right? So that's going to get harder. So that's also going to be hard. So I think that's where the model is evolving. From our perspective, we do, to come back and to finish on it, Deepak, I think, like Jeff, we don't think it's the same type of founders exactly, right? I think the model only works if you pay 3 to 5 times cash flow, and if you start paying 3 to 5 times revenue, I don't think you can create that much value. Anyway, over to you, Deepak.
Yeah,
Would love to hear your thoughts.
I've been fairly vocal on this on Twitter. So if you Google it, you'll see it. Yeah, no, I'm not been sitting on the fence. All I'm saying is I'm skeptical. I've also learned that great entrepreneurs deliver. And many of the founders of these Thrasio platforms, the ones I know in India and Singapore, are fantastic entrepreneurs. Yeah. Almost all of them are second or third time entrepreneurs and have built and exited successfully. So they know what they're doing. I'm just questioning whether this model is going to play out and play out to the extent that can support 20 of these guys out there. So I actually follow the space very, very closely. I track them as closely as I can, because I want to see what they're acquiring. Many of the businesses that are being acquired are businesses I've seen. As Nick said, they're not paying 3 to 5 times EBITDA. Almost every deal I've seen so far, and I've not seen all of them, are priced between 2 to 6 times revenue. So these are fully priced deals. And the question then becomes, how do you scale something like this to offer an exit to a buyer who may want to buy only one brand, not all the brands? And if you actually share resources and actually put in the operating leverage, which Nick said, which you have to do to create value, and it's time to sell, how do you then extricate the brand to a potential buyer when the leverage is more sort of shared amongst a number of brands? But the reality is, it's a pool of liquidity. It's now, as an investor on the ground, me and my team are getting offers from these funds to acquire some of our brands. And we are facing competition from these brands as we look at sort of backing some companies. I've just got a time check. We have 12 minutes to go. There are quite a few questions in the Q&A. I'm going to try and bring 2 or 3 in now, but please keep asking the questions. A couple of people have asked about our focus on brands, and we talk about brands, and they ask about private labels and cost leadership in consumer staples, like how Aldi and Lidl are doing in Europe and Turkey. Let me ask Nick and Jeff, and I'll then share my view. I mean, are any of you looking at businesses that are playing in the private label or cost leadership space versus sort of trying to build a brand which stands for itself? Jeff?
Yeah. So I think at least what we see across our portfolio companies, the private labels will be an important part of their strategies, right? And when we want to talk, so I would say that the private label is not a brand play, right? Because it's private label. So when we think about private label, we think about distributions, right? So people who have the distributions, and they will think about the private label. So the short answer is yes, and there's two paths or two playbooks that we can go for consumer. One is cost leadership private label, or two is building brands, right? And when building brands, we talk about why they exist. Nick mentioned about the value that this brand stands for. That's the playbook, and usually they have a more premium on that, right? So but for private label, it's more important for people, for companies who have massive distributions.
Yeah, from our side, we invest in brands, right? And so a typical private label as an Aldi, we would not look at. That's not kind of our investment thesis. However, a number of the companies that we are looking at, and I'm thinking of e-commerce platforms, are launching their own brands and selling 25-30% of their revenues are from these owned brands, right? So that for me is not a private label. It's an own brand by a company that we invest in. But the brand can stand on its own 2 feet, right? The brand has preference, awareness, and has every single metric that you would see in a traditional brand. So that we like, and so that, of course, we're investing in because it's based on data, it's based on the information that the company is gathering from the market, from the other product that it's selling, and it's then launching specific products under its own brand. So that we believe in strongly. Private label is less of our thing. On the cost side, we tend to focus more on, I'd say, the long-term consumer trends that we're seeing, Deepak. And we did mention value as something that has come up, but it's not really one of the trends that we're playing in. Generally, we tend to kind of focus on more longer-term emerging trends, where we do believe that emerging brands will have more chance to disrupt the incumbents. And so there generally is slightly more of a premium play. However, that is not to say that for us and for all the companies that we invest in, supply and having the lowest cost at the same price at the same point where you're playing is critical. And so all of the companies that we invest in constantly focus, of course, on the sales and distribution, but on optimizing supply chain, quality, cost, and so on. So I think you can never negate that, but it's not a play that we're focusing on.
Okay, I mean we've got tons of questions coming in the last 2 or 3 minutes, so I'm going to just quickly go through them as quickly as we can. Next question. What are the broader impact of the pandemic on consumer demand and behavior, especially in emerging markets, especially with job losses? I think we did cover it. Is there anything you want to add in terms of, with the hypothesis that there's been more polarization of wealth, haves and not haves during COVID? What are we doing in terms of focusing on brands or products at the bottom end of the spectrum? Is there anything you guys are looking at specifically in terms of what can be done from a business model point of view to address that, they are arguing, growing segment, the barbell effect in income?
Yeah, maybe if I can just give a quick observation, what we see, at least in Indonesia, is an emerging market. The bad news is that people are cutting down the consumptions to the really, the staple ones, the basic ones, right? So the disposable income is not that much anymore. So I think in the mass market, the bottom of pyramid, we need to be more careful about that, because definitely there's a contraction there. But there's also a question about how is it impacting the luxury retail, like what Deepak said, right? It's a very, very big difference between the haves and the have-nots, right? So the luxury retail is actually doing pretty well. A lot of people are still doing pretty well, at least on the top part of the pyramid, and then they're spending. So we see quite a big gap there, and then we just need to be mindful on these two segments.
I guess for us, we look at it this way, right? In traditional retail, and you'll know this, Deepak, shelf space is critical. And so it's quite hard. And, there are a few that have done it very successfully in India and in Southeast Asia. It's quite hard to come with a value product into traditional general trade retail and to push it through, because you don't have any premium, any margin to give to the retailer, so it's very hard for a non-incumbent to come through general trade with a value product, I find. Now, online, and so I think that's why it really changes from category to category, right? Online, however, you can disrupt, or digitally, you can disrupt much faster. So if you look at health tech, for example, you're seeing a number of new kind of things which are just bringing the price down, actually, and would making it more affordable. So I think it really depends. It depends really on category for me. I'd say in F&B, difficult, but then in other categories, we're seeing that as well. So that's the way we think of it. And then also, we shouldn't forget that, this is not really, I guess, based on more the income pyramid or income dispersion, but it's more on the Gen Z, right? The Gen Z, as they're coming in, as they're growing, and as they're coming into kind of, fully fledged consumers who can start spending, for them, ownership versus subscription or usage is very different. So they don't need to own it as long as they can rent it. And so I think that's also a way where you can address kind of this fundamental kind of income gaps or differences where people don't necessarily need to own as much. They can also just subscribe or rent or whatnot, right? So that's a difference in model as well that we're seeing.
Makes a lot of sense. And many of these trends were playing out, I think, prior to COVID anyway, but it sort of forced people to get there quicker. I'm going to sort of amalgamate a couple of questions which I think are interlinked. Most VCs have ignored the consumer space. Now that we are seeing exits and returns in this space, will we see all the major VCs rushing back into tech-enabled consumer startups? And I want to link that to another question is, how important is the synergy between brick and mortar and digital in the consumer world? So before I ask Nick and Jeff, let me just share out our perspective, right? Our view is that consumer brands are not tech companies. When I set up DSG 9 years ago, it was with the hypothesis that to build a consumer brand is very different from building something that's internet e-commerce driven. There's a community building, there's product building. Unlike tech, brands are very unlikely to dominate a market. The number one, number two, number three brand in most categories often is a single digit market share, 8, 9, 10, 11, 12. There might be large companies that own multiple brands and therefore have a larger market share. So the question, let me ask Jeff first, do you see all the traditional tech VCs coming in, competing in the consumer space? And do you think they have the right to play in the space? And do you think they have the right to win in the space, given their background?
Right. So this is very interesting because we are one of the first few VCs that are, investing in, for example, coffee chain, F&Bs and all that, right? And we invested early. We invested since from seed. And when we are offering this to the follow-on investors, Series A and Series Bs, there are very clear answers. Some VCs say, okay, there's no tech. I do not want to touch it. Some are more open-minded, right? So I think it all depends on the mandate. I still see some VCs are really, really strong with their mandate that, okay, no tech, I don't want to touch it. But I think with the market is growing, I will say that the consumer play have a higher predictability of exits. And like what Deepak said, which I fully agree, is not winner take all. The risk reward, it makes sense. And I think it will make more and more VCs coming into the sector. But I wouldn't say that we will attract a massive amount of new VCs coming into this because they all have the different mandates and different view on how they invest.
On that, Deepak, I think it's, for me, I think it's a difference of markets yet, right? I think in India, the answer is a clear yes. And it's as well from tech VCs as from more generalist funds. So, if you look who we're competing against from a growth perspective, we're now, we're competing against Principles, Premji, Kadara, funds which are more kind of traditional or generalist, right? And that are coming into the consumer tech space. And I think we'll see that more and more because we're seeing exits now in this space as well, right? So think Burger King, think Zomato, there's Nike coming up in India. And so there's the maturation of exits and now clear IPOs, which have been successful, has also kind of opened the eyes or kind of brought more interest into the sector. So that's definitely one. I think on the other question, I believe you asked us about convergence of physical and kind of online. And I think that's one of the trends that I mentioned that we're seeing earlier as well, is that people that, from a brand perspective, people that buy online and offline actually spend much more than someone who's just online or someone that's just offline, and it's generally a much stronger ambassador to the brand. And so we think that it's clearly a trend that we're going to see. So we do feel that offline will rebound in all of our geographies as soon as the pandemic is over. However, we do think that brands that can bring in can kind of really fully integrate that digital and offline experience will be the one that will be the long-term winners.
I think that's consistent with my view and our view at DSG, which is a brand needs to be where the consumer wants him to be and where the experience can be felt and the purchase happen. For some brands, it might be only digital. For some brands, it might be only sort of traditional. But we believe that over time, every brand needs to be digital and retail, and maybe even in the metaverse, right? If you look at how the under 18s are spending their money and spending time on, whether it's gaming or on Sandbox or in Decentraland, these guys are spending real money buying digital items. And how do real brands sort of cross the chasm and play in that space? I'm going to try and squeeze in one last question.
Well, I think, Deepak, just to interrupt, sorry, but I think gaming is one thing which I haven't spoken about, which is a huge trend, which is going to take over so many aspects of all of our lives. I mean, and I'm sure you're looking at it. We're looking at it very closely as well, for sure.
So I think we are learning about it at DSG. We know the guys who are good at it are very, very, very specialized, and they tend to come from gaming or the blockchain ecosystem because the early adopters tend to be from that world. But you're right. The consumption dollars, the discretionary consumption dollars, which are being spent on my companies, are gonna go in that world, and we need to learn how to compete in that world. Last question: in terms of broader consumption trends, there's a shift towards less consumption, anti-consumption, sustainable consumption. What is the impact of this on the industry in Southeast Asia? Jeff, how do you and Nick think about the move towards sustainability and consuming less, which is better for the planet, as you sort of back new startups encouraging consumption?
We are looking at that closely, but to be honest, at least from Indonesia's standpoint, it hasn't played too big of a role yet. I think we are still early in that curve.
Yeah, I think I think health and wellness is more present. You spoke of Lemonilo, Jeff, and a few others. I think sustainability is definitely a long-term trend that we strongly believe in. I do think that the Asian consumer is still at the beginning of the journey, and I think it's important for brands to start positioning themselves and adding that from day one, because the difficulty for any brand is to start doing it after 2-3 years, because once you've built up the supply chain, it's much harder to change it. So I think my advice to brands would be start doing it from day one, because once you integrate it, it's much easier going forward and you don't have to change it. But I do think that it's a big differentiator. And so what we're seeing is a number of brands offering the same value, the same product, the same service at the same price, but with an added sustainability component. And for me, that is a winning combination.
Okay, I agree with the both of you. I've got 2 warnings saying we've already crossed our time. So Jeff, Nick, thank you very much. And all the participants who asked questions, thank you very much.
Thanks a lot.
Thank you, guys.